Welcome to the IE's 16th webinar of 2025. My name is Jacqueline Kagume, and on behalf of the IE, I'm delighted to welcome you to our discussion this morning, where we'll be discussing the Finance Bill, now Act 2025, the amendments that were made, and the question that we are asking is whether it suggests real tax code reform or it's mere rhetoric. So the IEA is a public policy think tank, for those of you who've not interacted with us before. And our aim is to inform decision-making in Kenya through research, policy innovation, and dialogues. And we work across 6 policy areas broadly on understanding the law and the economy, public finance management, economic regulation and competition, futures and foresight, popular economics, and international trade. So that's the focus of our work. And today, the CLE program that works around the constitution, law, and the economy is the one that is convening this meeting. So we welcome you. And as you can see from the title, what we'll be sharing today is our reflections on the finance bill that has now been assented to. So basically, it's now an act. And so we'll be sharing our thoughts on whether we think the proposed amendments, as I mentioned earlier, represent a genuine step forward in terms of reforming Kenya's tax code, or whether what we are seeing is more of the same. I think annually we all see, in terms of annually, we have, you are all aware that we have a finance bill that is passed annually that suggests various reforms around Kenya's different taxation laws, and basically trying to set out the revenue raising measures in terms of the revenue that is raised from our taxes. So annually, we've been seeing various amendments proposed to all the different tax laws. And what we are trying to see today is whether is to understand what exactly should a finance bill ideally accomplish. We are trying to see the specific reforms that are proposed annually. Do they align to the principles of sound tax policy? And we will discuss that with you. And that's in terms of simplicity, equity, efficiency. You know the core tenets that are listed as the core taxation policies, or the hallmarks of a good tax policy. And so we'll also be seeing or looking at what the data tells us. So, and this is through a tax policy and elasticity lens, trying to basically understand how some of the measures that have been proposed in the law affect behavior or are likely to affect behavior in terms of revenue outcomes and in terms of economic activity. Then we'll also be sharing our overall thoughts in terms of the key messages and some takeaways. And the goal that we have here is to basically provide you as our audience with some clarity on what's the law, the amendments that were made are actually proposed, and also to provoke some discussion in terms of what we all think in terms of the soundness of the amendments and the coherence of our tax code generally. So in a nutshell, that is what we are discussing today. And we have prepared a presentation. My colleague and I work in the Law and Economy program, that is Leo. And because this is not a very long presentation, he'll be making the presentation. So I'll invite you to, if you have any questions, to note down the questions, and I'll allow you during the plenary session to ask what questions you have and to make your contribution to this discussion. So that said, I'll just go right ahead and invite Leo to go ahead. Leo?
Thank you so much, Jackie. I hope I'm audible.
Yes, you are audible, Leo.
Yeah. So the revenue outside the budget, another major policy event in Kenya is the process of finance bill. As we've provided before in IEA webinars, the finance bill is an omnibus legislation that actually targets to amend several acts of Parliament to provide for revenue raising measures in that financial year. It's a feature of a Westminster model or parliamentary system of government, but still here it is. So one of the things that you all know why we should have this kind of a discussion is first, this is a contested policy space that various persons and agencies are trying to bring forward ideas on our revenue raising measures, while on the other side, independent actors like ourselves, citizens of the Republic, and many other people trying to see how those revenue raising measures will affect them. So if you look at the report of the Department Committee of Finance, there was significant 198 written responses, 1282 QR code responses. Then they got email responses from 164. And secondly, another thing that you also notice from the report is that government agencies, various ministries, not just National Treasury and the Kenya Revenue Authority, but other agencies, including the State Department for Tourism and others, also responded to the same. Why is it also a very important issue? Uh, the, the key aspect of the state is to provide public goods, publicly provided services, and that now this is one area where the state makes the claim that they are raising revenues to do the same. But again, uh, why is it important to have a discussion is sometime or most of the time, the revenue raising measures brought forward have unintended consequences and affect the constitutional rights, like Bill of questions about fairness, 40, Article 47, Article 40 on property rights, and many others. Again, Kenya's public finance architecture is very unique. It's the reform process to the constitution largely had a PFM angle, and one of the things that the 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 drafters and the Kenyan people were keen on is that some predictability in how public finance operates. So they stated principles in Article 201, amongst other sections of the Constitution, on how taxes should be raised. Now, and this is the view of the Institute of Economic Affairs. Tax proposals have to bring efficiency, meaning it doesn't have to affect markets. It doesn't have to change economic behavior. And that means that given that the literature review that we've done, including on papers written by Nobel laureates in several years, including Peter Diamond, James Marlis, and others, there has to be an essence of efficiency. And efficiency in essence means tax rates have to be low, uh, lump sum taxes, and the others. And then look that a tax design system has to factor in regressivity. Now, what should a tax bill achieve? It has to achieve policy coherence. And policy coherence is not just, so for example, you can mention like government of Kenya has given forward a policy idea that they on housing, on housing, and they want their view, which is not true, is that there are very few houses, and more houses need to be built, and there is an housing problem in Kenya as a matter of quantity. Then when you look at the Finance Bill 2025, and then you see items on housing being standard rated, VAT standard rated. And then you start to wonder now, where is the coherence? So that's the essence of coherence. Coherence is to say, does it align with the policy goals, the intended policy outcome? Does it meet the consumption threshold in economics? Does it meet all the other things? So does it push, another objective is, does it push the tax code towards optimal taxation system? And this is, does it ensure minimal distortions? We've said a tax is a distortion. In principle, a tax is a distortion. And what it does is that it creates deadweight losses. And by creating those deadweight losses, it shrinks the market. So it means you have to be very careful in the manner of on how you advance tax proposals, because those economic objectives uh, 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 are inherent. Taxes also change behavior. So you might, so like for example, it changes behavior. One side. So let me give an example. In 2015, the an higher rate was raised on what we call the on an alcohol produced from sorghum, from sorghum. It raised the prices significantly, that the market actually for that brew collapsed, and that the following year now National Treasury had to bring forward another proposal. So it changes behavior. Taxes change behavior. Then again, does the revenue ratios meet the principles of sound tax policy, and whether those taxes would achieve political consensus? So political consensus here is very simple. And I'd like to use the example from the Finance Bill 2024. See, political consensus is logic. It's just the way people look at issues. So you cannot, for example, you cannot exempt an helicopter or an helicopter from VAT and put the same VAT on bread. So and given the fact that bread is like, especially in a country where malnutrition and calorific deficiencies and is a serious problem. That is something that it shows you that some of these there has to be some sense into some of those proposals. Now, generally, if you look at the Finance Bill 2025, we are calling it like a tax administration, a tax administration and a tax expenditure, like largely proposals relate around those areas, because one thing that you see, they're getting rid of many of those tax expenditures, and uh, uh, secondly, they are adding more tax administration measures for every types of, not just on the tax procedures side, but also with the VAT and others. Then you see preferences. They're raising preferences, and this includes the Nairobi International Financial Center. Then there are issues on tax exemptions related to now, like pensions, gratuity, and others, and then penalties. Some of those tax admin measures include advanced pricing, tightening measures around filing of taxes, uh, expansion of commissioners' powers, changes of timelines of payment for some taxes, including, so I've given an example, we've given an example of the minimum tax. Now, so the tax foundation provides what we call the four rules. Essentially, if you are dealing with a distortion, the big issue should be, how do you reduce the number of rules that are used to administer a tax system should be fewer. And so one of the things around sound tax policy is simplicity. Tax rules should be easy to understand, comply, and administer. Transparency. Taxpayers should clearly understand how much they pay and why. Neutrality. Taxes should not distort economic decisions or favor specific activities. Stability. The tax system should be predictable to allow for long-term planning. But again, we had so just to show how this applied. So, for example, we chose some very few proposals to highlight why. So, so one of the proposals that were brought forward and subsequently amended in Parliament was that the period for carrying forward tax losses was lowered from indefinite to 5 years. Now, upon public participation, they added another 5 years, but subject to application. You have to apply and state the reason why. There's a big problem. Why? Because there are projects that there are investments that require that its horizons are long term, and long term here means more than 8 years. Uh, uh, so you see that farms with long investments horizons, uh, and given that we all know that economies operate through what we call business cycles. So sometimes it's at a slump, sometimes it's growth, there's growth, sometimes there's stagnation. So that business cycle within that 5-year limit in itself is a big problem. We even gave to Parliament an example that manufacturing uh, investment horizon, given the data that we had seen from the Kenya Association of Manufacturers, requires 8 years. And that within that 8 years, you'd need so the first for you to even start to break even, it's the first 8 years. So this proposal would affect that, but MPs were not convinced, and they went ahead and only said 5 years, but another 5 years subject to application. Second question on there was some exempt. There's a very long list of exempt supplies. Exempt supplies that were exempt: medical supplies, housing, renewable energy. So and that they were standard rated, meaning that it changed from the new rate is 16%. And that in itself would raise costs, not just because we've checked elasticity. Elasticity is higher on the demand side, so more consumers are going to bear that cost, but also uh, manufacturers or people who are in that specific people around specific around who are working in those areas are also going to bear those their costs, and that will raise the production costs and disrupt value chains. Scrap metals. Uh, so scrap metals. There's a withholding tax on scrap metals. Uh, so scrap metals in Kenya is largely like what we would say an informal sector, but at the top there would be a larger aggregator, somebody would buy from that. Scrap is important. This kind of business is important because of environmental concerns, and also raising the like promoting the circular economy. So this kind of attacks, there's a problem now because that administrative efficiency to be able to bring all those into the cost of administering that tax, it'd be a big issue. elimination of investment deductions in special economic zones and regions outside Nairobi and Mombasa. So one of the things that we've noticed after studying Kenya's tax code for over time now is we have what we call dual tax systems. So like now, people who promote investments on behalf of Kenya say that FDI is low. The foreign direct investment is low because of problems of tax, issues with tax. So how do we, and then government decides that to do that, they will need to introduce now special economic zones, uh, 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 special economic zones, and introduce tax measures such as investment deductions that are tied to geographic regions. And that's why we see a problem. Why? Because if FDI is low because of tax, it's the main issue should be to review that tax measure, those tax measures, to ensure that they're in a point that would allow investment flows to come into the country. But now you see that because if you look, so we looked at the manufacturing data from, if you look at the gross county product that now details the sizes of county economies in within counties, close to 71% of all Kenya's manufacturing is uh, in 8 counties, and in fact, Nairobi alone accounted for 30, almost 37% of that, with the other being shared, 34 being shared between the other 7 counties. So tax system, a dual tax system, and by dual we mean that they are for the same types of farms and the same types within the same region, you're having different kinds of tax systems. Those tax systems should be reviewed to ensure that there is uniformity, but also that they do not favor movement of capital to only specific counties and not the entire within the entire republic. So that's a problem. And even MPs who just represent the other regions should start thinking about these kind of things, because if we are to have an investment profile that reflects the realities in this country, it should not be market driven, determined through agglomeration, but not just through uh, any other form of government policy, because this is state-led policy directing where private investment should be. Now, so that's on that. Now, the other things, there are issues like on advanced pricing agreements and country by country reporting requirements. Uh, so you're giving powers to KRA to be able to negotiate advanced pricing agreements. Um, there's a problem with the way those advanced pricing, those are very complex instruments. Negotiation alone might take something around 3 years. An agreement would be in place for 5 years. So it's raising complexity. Two, we've had conversations, some significant, only this favors large and established firms, because you're able to engage transfer pricing experts. You're able to do, there's a lot of technical work that you're able to do. But if you are an SME in Kenya, and we all know about many other SMEs that export to the region and not and to many other places. So then another example, just to highlight, I don't want to dwell on many of them, is the question of, so for example, one of the things is the fringe benefit tax. The fringe benefit tax it was written, it's now, the fringe benefit tax, as you all know, is the tax on, especially in Kenya, on loans that are offered by firms to its employees or the other benefit. So in Kenya, it was written that if you are given a loan and the difference between the market rate and the the value charged by the farm would now be considered a fringe benefit tax rate, and that would go to government. Yeah, so in most of the time it would range between uh, six to between 6 to 9%. But here they're saying it's at the corporate tax rate, which is 30%. So 30% of that 30% now of that fringe benefit that you get will have to go to government. And problem is now that will change. It misaligns the value, the true value. It's not, it's regressive because it will affect low income earners. But the aspect is that it will force farms to change the way they account for these fringe benefit taxes. Then there are the provisions on timber deductions, the provisions on they changed many other so excise duty on imported basic inputs like glass, plastic films. So they're charging excise taxes on non-final goods. These are intermediate goods because you're not. If you come with a glass, you're not. That's not a final product. So we also considered elasticity. The reason why we are making, they sound foreign and they might sound too ambiguous, is that we're introducing concepts of taxation like deadweight loss, elasticity, and those principles of tax policy, because there's a problem. The problem is we need to move away from that kind of analysis that we say that this is an high tax rate. We need to say this is an high tax rate because it reduces this kind of it imposes this kind of costs, and it will shrink by the market by this quantum. So that's the importance. So for example, in elasticity, um, so there are different types of elasticity. There's what we call the price elasticity of demand, where we measure how quantity demanded responds to price changes. And this includes now the component of taxes. We have income elasticity, how demand changes with income levels, elasticity of labor supply, how people adjust work hours in response to income and payroll taxes, investment elasticity, uh, investment response to after-tax returns, tax-based elasticity. Now, this is the how tax when you change rates and you change the base, how the rate changes with the base. So it allows you, because each of them. So like price elasticity, let me use an example. Price elasticity of demand. So in 2023, not 22, when the fuel prices changed from 8 to 8% to 16%, we were able to use actual data to calculate how demand changed in the subsequent, in that month when the rates took effect. And so price elasticity of demand was very low for diesel and then subsequently petrol, but very high for kerosene. And huge sections of the market were lost because of that. So elasticity is an important aspect. So just to use the examples again, so if you look at inputs in whether health, whether affordable housing, animal feed, all of them are price sensitive. They have price sensitive demand. And when those prices would be by a larger part of those prices would be passed to consumers, and consumers might reduce consumption or switch to other alternatives or seek even supplies in what you call the informal sector, because like animal feeds, for example, a majority of that is a larger part of it is imported and from places like Zambia, Uganda, and because of very obvious reasons. Uh, uh, Most of them actually require come from either the arable land, the size of arable land, and the others. So, so, and so we look at that elasticity, and then if you look again at the question of shortening the carry forward for period for tax losses, uh, we look at that investments, especially in infrastructure, manufacturing, or extractives, is affected by those after tax returns, and given that the margins, uh, uh, so and that likely behavior is firms might actually reallocate investment away from that. I think one of the biggest sins, if you ask me, that this elected government has committed, this Kenya Kwanza government has committed, is that in their manifesto they wrote that they recognized that capital allocation was being affected by many other factors, including government policy, and that they would change that tact by ensuring that markets determine how capital is allocated within the economy. But you see now that through tax policy, through tax, they're changing that. So there is the question of digital services and digital assets. So in the proposal, they had wanted to expand a significant economic presence tax to all non-residents, regardless of turnover. But in Parliament, some reasoning prevailed. But again, we need to evaluate them because we need to change the way MPs, because MPs are the taxmen, is a taxman in this case. A parliament is a taxman in this case. How they look at this. So and that demand for digital services is price elastic, especially to small non-resident providers who can easily exit or geo-block Kenya. And it's mobile, it's sensitive to transaction costs. And so, but again, it's difficult to enforce because they might switch the traders might switch to peer-to-peer channels to avoid tax feasibility and catching up. So it's not necessary to have tax proposals that require a lot of resources to collect. So we had a discussion on so elasticity again. We're just showing now elasticity analysis again with the fringe benefit tax. If what happens to an employer, what happens to employees' demand and substitution effect, because employers might shift to untaxed benefits and employees might turn to digital or informal credit, especially for smaller amounts, especially for smaller amounts. So again, another problem with coherence in Kenya's tax code is how different types of taxes are misapplied. So let me give an example. If you look at the value-added tax, it's a tax on value added. It's a value-add tax. There must be value add for that tax to stand. If you look at income tax, it must be on income and it must be on gain. Income, what has been gained. If you look at all different types of taxes, and now if you look at excise taxes, and this is my favorite tax to always explain, because the excise tax is a tax on negative externality. And that negative externality, the keyword here is that negative externality. That externality has to be proven. It has to exist. So like very simply, excise tax on alcohol, as there is harm uh, on alcohol. Excise tax on cigarettes, on fuel, there is a problem when it leaks to the environment and all the other things. But when you look at it, in the Finance Bill 2025, the expanded definition of digital lending to include almost all types of lenders, almost all types of lenders, especially if you're just lending and on a digital platform. Uh, so, but there is a problem. Lending, the lending is not, it's intermediation. It's fine. It's part of credit intermediation and part of financial intermediation. So there is no externality. There is no externality. There is no externality. And then, so like if you take, if you look at, if you use digital lending platforms, especially banks, and you look at what government is taking out of that, it's a significant amount. It's a significant amount. Then you ask yourself, then people come back again and ask themselves, why is credit intermediation slowing in Kenya? There is a problem because there is a disconnect in how such things are applied. And the reason why they came into Kenya is what was called Robin Hood taxes. So everything that is a global term, it's brought here because there is no externality, and that's the point that we hope that once a new tax policy is passed, by the time the tax policy, a new tax policy should reflect that reality that only accessible goods can be on those that cause a negative externality. But if you look at government, they see it as a method of raising revenue, irrespective of their unintended consequences. So as we wind up, key messages. So one of the things that you look at is, so our the in Kenya, the law requires that Statutory Instruments Act requires that any proposal that is deliberated by Parliament that has adverse effects, that evidence, in fact, they require that regulatory impact assessment be done, but there should be some level of evidence that is shown that this measure is necessary, and that should be part of the discussion and public participation. But again, you look at it, we only saw through a press release that Cabinet had approved Finance Bill 2025. There was no evidence that shows why each and every of those measures that was brought forward in the Finance Bill was needed, and what were the deliberations at every stage throughout the process. Because that's for every policy, there is a deliberation why that needs to happen. And even at Treasury level, when they aggregated those measures, what economic analysis, when they aggregated those revenue raising measures before they forwarded it to cabinet, what economic analysis informed some of those decisions. Where they are making revisions, what data they brought forward to show that that was necessary in the first place, because that's how other economies, advanced economies operate. Operate. The second question that we want you to take away is that the claims that tax rates uh, were not being raised, were not being raised are untrue. Because the messaging around the Finance Bill 2025 was that there is no tax rate that is going up. So we've shown, for example, like fringe benefit tax, it's being raised from a weighted average of around 6% to 30% to corporate tax. And then there is a problem with tax proposals complying with public finance principles, ensuring fairness and protecting rights. Because like, why VAT, some VAT on one area, like the pharmaceuticals, is being standard rate? Why not the other? Why not everything else? You know, like the constitution requires us to explain the other logic outside explaining, showing evidence and showing data to explain the other logic. And then the economic criteria for tax bills, it should ensure policy coherence, optimal taxation, minimal distortion, should follow sound principles, especially on the administrative side. And then eliminate contradictory proposals, contradictory proposals. And then elasticity matters. So thank you so much.
I think Leo's presentation was pretty self-explanatory, so I will not try to provide a recap. I will go straight into plenary and welcome any contributions to the discussion, any questions, any thoughts that you might have. I open this now to plenary. If anyone would like to ask a question or contribute to the discussion, please raise your hand. And I will allow you to, yes, I see a hand up by Mary. And as Mary asks her question, if anyone would also like to type in a question, we have a chat box here. That on the chat, you can write down your question. So Mary, please, yes, go ahead and ask your question.
Sorry, I'm very new to this forum. It's my first time. Thank you so
You're
much
welcome.
for having me. I just wanted to know, what is the difference between this finance bill that's been passed and the one that was rejected last year?
All
Very
right.
briefly.
Okay, thanks, Mary. We are noting down the questions. So let me see. Samuel says, if anyone else has a question, please also raise your hand and I'll allow you to ask. So Samuel says, oh, okay, sorry, it's not a question. Yes, you will have, this meeting is recorded and we will upload the recording on our YouTube platform. I'll share those details later. So yes, this will be available to you. Is there any other hand? Okay, so Leo, would you like to attempt a response?
Yes. So the difference between Finance Bill 2024 and this one is that in this one is they are a little bit cautious of the other one was purely insensitive, that level of sensitivity. So they want to build political consensus. But in terms of now speaking empirically on questions about tax burden, whether it increases tax burden, whether it will affect investment and the others, the evidence is straightforward that it's there. So in terms of the other one, for example, they had audacity to go into areas where Kenyans already saw that this is just going overboard. But in this, it's a more and this is a political economy tactic that, as people study the tax questions, is that the government got clever in how they want to build arguments. So, for example, when they said that they were not changing any rate, especially where they knew that where there is no express rate going up. But in essence, when you look at the tax burden and now they are changing legal definitions and the others, you realize that they are they are increasing taxes anyway, even if you look at the way they did. So I can say in terms of severity that there's no much bigger difference, but the only thing here is that level of sensitivity, that there's some level of sensitivity. So the part that we now need to work on advocacy questions is whether there is coherence or whether there is that reform. But in terms of severity, you still see real effects on that. Yeah. So the other.
Okay. Mary, so Leo has responded to it. From looking at the Finance Bill 2025 compared to the 2024 one in terms of actual proposals and amendments, not much in terms of the specific amendments had changed from my perspective. You could see that specific amendments, for instance, the ones related to the significant economic presence tax, the amendments that were related to allowing KRA to access financial data, which of course did not pass. There are some amendments related to the advanced pricing agreements. Most of the amendments were actually there in the previous bill that obviously was rejected last year. But because IEA does an analysis every year, we could see even from our own analysis for each of those heads that the same amendments, most of them were repeated. Some placed or stated differently, but most of them were actually repeated. So as Leo has said, maybe there is some level of added sensitivity, I suppose, from Leo's perspective. But in terms of phrasing, most of those, the specific amendments were the same, according to me. And we have an analysis of the different, if you go to IEA's website, you can access our memoranda on the analysis of these bills from last year and also for this year, and check and see. Well, of course, they did away with the controversial provisions, for instance, the ones on the motor vehicle, the VAT, the problematic VAT amendments, those ones were done away with, but then the majority of the ones that did not pass repeated themselves here, and the ones that were not repeated here was sneaked in or passed through the tax laws amendment bill that was passed earlier in the year. So that would be my feedback to you. Let's see if there's any.
Can I
Yes.
can I just say that
Sure.
there is no difference. It's just the same document clothed in another clothing. And I expected this webinar to actually bring that out
Yeah.
and just be truthful, just tell us the truth. That on one hand,
Yeah.
the bill is the same. It's just, changed here, changed there. And then if you say half of it is being passed
Okay.
before
So
today, I think it would be much better to be honest than, but thank you for your
sure.
explanation. Thank you.
Yes, sorry. And I know Leo
So
is burning to come. Just a minute. I know Leo is burning to respond to that. It is not exactly the same. Actually, even if you look at the amount of revenue that was intended, that can also give you a picture. If you look at the amount of revenue that was intended to be raised from the first bill, the one that was rejected, look at the subsequent amendments, and then look at what is in this one. So it is not exactly the same. The phrasing of some of the amendments, a significant amount of them, the ones I've talked about, like to do with significant economic presence tax, the advanced pricing agreements, a number of them across the different tax heads are the same, but we cannot also say that it is fully the same, because even if you look at the objective, I mean, the revenues that were intended to be raised have reduced significantly because some of those amendments were thrown out. So it is it is not exactly or entirely the same, but there's a good proportion of it, and we can provide you with synthesis of what fraction of those amendments were the same later, and which ones were ejected. So Leo, can. Yeah.
Yes. So the other one intended to raise 177 billion. 100 and yes, even, and then on the this one intended to raise 30, and then it was revised downwards to 24. But what we are saying, Mary, is as the Institute of Economic Affairs, we know what an optimal tax code should look like. We also know how tax policy should be drafted, the processes, and all those things, including the fact that that tax should not change investment patterns. Tax should not do a lot of these things, and we are pointing them out. And we are not. For us, the key thing that we want government to the government of Kenya to be, we are not looking at what they've done positively. We are looking at things that harm people, because when capital is misallocated, it has an implication for jobs, for welfare, for livelihood, or when VAT on on health on health inputs is standard rated, you raise it to from 0 to 16%. You are creating a problem. Or when you add more powers to the KRA commissioner, you add more commissioner powers, you are disenfranchising Kenyans and affecting economic freedom. Those are the things we say. And given the fact that the IEA is that our view lies largely on not is not ideological, but rather driven through markets, free markets, and empirical evidence. That is what we like, and we want treasury. So in essence, if you're looking for a summative view to say that this is it's not the same, because they've changed the tact. They know Kenyans will be on the street on the same day if they continue with the level of insensitivity that they had in 2024. But what we are seeing hidden things, and that is the thing that we are trying to come through this, is that language that is couched in policy language couched as saying that they are not raising tax rates. But if you look at it, if you change definition from exempt zero rated to standard rated, you are changing it from 0 to 16. So that is the kind of public education we are coming with, and we are not giving a summative, conclusive view on whether this is the same or the other, but we are showing you that for each and every tax motion, and we'll continue to evaluate, because for us, we are looking at the policy side, which is, are we moving towards a better tax system, or we are regressing? And we're saying that, yeah, it's just still the same rhetoric, because you say you will not misallocate capital in the manifesto. You will not change government policy in a way that misallocates capital. But yeah, when you look at it, people are just, so that's the idea. You prefer multinationals over SMEs. SMEs are 90% of Kenya's business. So those are the things we are bringing forward, and those are what we like people to see, to understand those specific proposals. Thank you, Jack. You are muted.
Jackie, you're muted.
Sorry. Does anyone else have a question? Please raise your hand and I'll allow you to contribute to the discussion. If you have different thoughts, this is your chance. You can raise your hand. I don't see any questions on the chat box. Is there? Yes, okay, so I see some comment. So Ian is asking, I'm left wondering, how can we raise greater public awareness around the critical issues? Because it seems the majority of the public remains largely in the dark when it comes to the finer details. Secondly, how can we position technocrats and brilliant minds like yourself in more influential spaces, especially to counterbalance political interference? At the heart of it, a lot of this ties back to what feels like budgeted corruption. So what practical steps can be taken to bridge that gap between technical insights and policy level impact? So that's a question by Ian. I'd like to allow somebody else to ask a question or to seek any clarification as we prepare to wind up. So if you have any burning comments or question as we prepare response to Ian, please ask your, let me see your hand. Okay, so I don't see a hand. So Leo, you can respond to Ian.
Uh, uh, yeah, so we have to keep looking, and even in Kenya once. So Ian, I agree with you that the work needs to continue around this area, even after it has been signed into law. An evaluation of these proposals that discussion needs to continue in preparation, because we already know that even though the finance bill is a feature of parliamentary systems, Westminster model, and should not be there in a presidential system, because in a presidential system, if you want to amend a specific act, you just amend the specific act, and then it's not tied again to uh, uh, circles, because so we need to do a lot of work around, given the fact that we know that the finance bill will come again in the next financial year. We need to do a lot of work and even raise what we call the minimum demands. What at minimum, what should a Kenya's tax legislation look like? And that could even include that there should be no annual finance bills, but maybe once every 5 years. There should be a lot of things that need to be done to clean up legacy questions from the previous constitution and the current constitutions to be able to meet the demands of the current constitution. Because even if you are an investor, you are planning on this finance bill. In July next year, you would have a very different form of a tax legislation. Tax legislation. Uh, so we need to have discussions that if we want predictability, if we want that stability, if we want that simplicity, what would we do? What would we do? I think the best support for the second question is for us to continue attending as we have these IEA meetings and IEA webinars, and to as our members to continue proposing areas that you think we should look into, and what practical steps that need to be to bridge that gap between technical insight and policy level impact. Because tax is an economic tax analysis is an economic analysis question. and then the others, accounting, law, and the others come after. We need evidence. We need, because the only way we are able to have a fair discussion between the executive branch, parliament, and citizens of Kenya and other independent actors like ourselves and professionals is if the government is able to show a chain of thinking from we are proposing this tax proposal because of this evidence, so that we discuss that evidence. Because now what is happening is we are discussing the merits without them showing us why they came up with that idea in the first place. And that should not be the case. And that should not be the case because we have to generate alternatives. Another thing is I think it's time now to safeguard parliamentary that parliament, given the fact that they have powers of tax powers of the past, because Article 210 requires that no tax proposals can be made without through legislation. Can be without legislation. We need to have a discussion of reorienting parliamentary budget office as an independent arm of parliament for them to be able to make alternatives to those proposals. There is a lot of work that needs to be done, because even if you look at what we do when we go to testify before the parliament on finance bill, it's just ugly. We need concrete so that we are discussing. Treasury said they are eliminating investment deductions for all areas outside Mombasa and Nairobi because of this reason, and 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 they give that evidence, and they even show the reason why that proposal will not work. That proposal would work and not the other alternative, and then we discuss from that point. But at present, we are discussing with people where there is asymmetry of information. There is a lot of background data that we do not see. There is a lot of things that, so we need to change. We need to have a discussion on how the entire process of finance of a tax legislation would be done. Thank you.
All right, thanks, Leo. So the next question, sorry, let me see. Sorry. So there's a question here by Lillian, or a comment. She says, Leo has made mention of what I was thinking about. Laws and policies need to be tested after a while. So say be in existence for 3 to 5 years. So why should we have these changes each year? Are there good grounds to challenge this? I don't know if I understand the last part of your question. So why should we have this change each year? Are there good grounds to challenge this? Okay, so Leo, I think you can respond to that as you make your closing remarks.
Yeah. Lillian, that's a very good question. I think constitutionally, there are very good grounds to challenge first, because that predictability, given the fact that our constitution requires makes provisions under Article 201, and now fair administrative action, where like that level of that legal predictability, that you can only have, say, these tax measures should not change, especially in a detrimental manner every year. every year. There are very good grounds to craft those arguments. And if you look at other countries, especially advanced economies, the way majority of them were able to ensure, because tax has a big element on economic freedom, because it's actually a limit on how you can enjoy your property. So in other advanced economies, what they were able to do is you raise the level of the threshold in which some provisions, all the provisions, tax provisions should be able to pass. And then now you test it against the constitution. But there are many grounds that can be used to test that, because not everything that parliament passes that we can say because parliament has power, that is true. They might even decide to pass to put aside the constitution today. That will not be correct. So we need to bring that reasoning. And given the fact that we know even the origins of why countries have constitutions is to limit the power of the state. Actually, if you read the constitution, it's limiting powers. A provision it's limiting powers and limiting that discretion. So we need to change. There are very good grounds to do that. Because MPs and the executive branch want to focus on taxes because it's easy. You are an employee. If you like the IEA, they can easily come to the IEA and demand for taxes. But to say that to pursue measures on economic growth, those ones are difficult because if you want to raise revenue, the ultimate way in economics to raise revenue is to grow output. You're able to grow output Kenya from $120 billion economy to $300-400 billion economy. That would give significant tax yield. But no one is interested in that part because that is difficult. And then that takes time. So we need those incentives to shift in a way that allows us to because taxes should only change on a minimum every 5 years, and they should change for a very, very good reason. And the data and empirics should be so clear, and conceptually, data, empirical evidence should be so clear that there would be no contest around those changes, and that should be the threshold. And I think for me, having and myself and Jackie and Kwame and other my colleagues, having studied this Kenya's tax system, we can conclusively say that that's the direction that we need to go. However, because you might even a new government, and when a new government comes in, they should not rush to see proposals that raising, for example, tax as a share of GDP is even a good measure in itself. We should have a lot of work done around this within institutional arrangements to be able to prevent these kind of things, because it's aggressive and economically wrong. So thank you so much. We look forward to future engagements with you. Back to you, Jackie.
Yes, thank you. Thanks, Leo. So as he said, for us, in our study of tax policy, best practice suggests to us that legislation and taxation laws, a good tax law should be in existence, good tax proposals should be in existence for a long time, for the predictability purposes of it. So the gap here, or what Parliament writes on, seems to be Section 40 of the PFM Act. That's, I think, in Parliament's interpretation or the Treasury's interpretation, they take it that they have a requirement or sort of obligation to present new tax proposals every year, which is not true, because the PFM Act basically states that on the same day that the budget policy highlights and revenue-raising measures are pronounced, the Cabinet Secretary shall submit to Parliament the finance bill, setting out the revenue-raising measures for the national government, together with a policy statement expounding on those measures. So I think they have often interpreted this to mean that they must bring about brand new proposals every year. While there's a requirement for them to present the finance bill annually, I don't think anything stops them from actually stating that we maintain the finance the proposals that had been suggested in a previous year for a certain period of time, just to keep those proposals as being predictable, basically. So I think that is the provision that they've used to make those changes all time and all those alterations every year. But basically, I suggest that that should not be the interpretation. So I have seen a hand, although we are trying to conclude. I see Carlton. Carlton, your hand is up. And would you like to ask your question? I'll allow you because you're a friend of the IEA. Please go ahead.
All right, thank you. My question is quick since we're pressed for time, but this one is specifically to Kemboi. What tax management, quote unquote, techniques can the government use in order to, for example, achieve certain objectives like managing the informal sector, which is hard to tax? So my question basically is specifically what tax management measures can the government put in place to achieve its objectives of fiscal adequacy, but at the same time maintain a sense of equity? Thank you.
All right. So sorry to bring you back, Leo. Just respond to Carlton in like a minute, and then we'll close.
Yeah. Carlton, you know that that economics is about managing scarcity. If you are to give the executive branch, because you said revenue sufficiency, there'd be no time that the executive branch reaches that. In fact, in some other countries, that revenue sufficiency, so like Switzerland, they put out something called the debt brake, which is they limited they limited the size the deficits, that they say you can only run deficits in a business cycle. So I wanted to first do away with that argument that there's something called revenue sufficiency. On the informal side, we've done, even given the fact that we've looked at so many other sectors of the economy in the real side, that we've come to this conclusion that actually informal businesses exist. Informal people who are in the informal sector exist because not because that they want to stay in the informal sector, but because output is small. And that even if you are to require, for example, a corporation tax for a kiosk or an M-Pesa kiosk, or some of those, they would collapse. In fact, if you are to compare these businesses between what we have in Kenya, what we call informal in Kenya, and it's just a problem of growth. It's actually it's a problem of growth. So there's nothing that says there is so much revenue to be collected from in the informal sector that government should now. It's something that the government has worked on for the last 15 years, saying there's an informal sector that needs to be taxed, introducing those measures, but that revenue is not it's not there. So the big issue, Carlton, the actual problem that government needs to address is economic growth. How do we take that output for these businesses? For that, let's say, to be able to get a net in, to get a gross in a business, those businesses to be able to grow, and it can only happen through growth, because that's how farms, households grow. And when farms and households grow, the governments buy. So we are defining. We are actually, that's a. We need to write that fallacy, so that, because that's something that government has already brought forward measures, but never even succeeded, because yeah. But I seen comments.
Yes, so I see Kwame also has a hand up. So Kwame, please unmute yourself and let's hear.
Okay.
Yes.
Well, I just wanted to come to respond to this, because I think it's pretty clear. So first, I think, yes, I had a question about whether we are honest in mentioning whether this year's tax rates, tax bills, finance bill is the same as last year's. There are similarities, but the purpose of our conversation today was not necessarily to compare those. That was done in our finance bill, memorandum we presented to Parliament on the finance bill, and perhaps those who want to can look at it. We hold no obligation, and I intend that for all my colleagues to understand that, to be apologies for government or any arm of it. I think our work is to dispassionately state what our analysis suggests to us, and sometimes it makes some people happy, other times not, other times people are neutral. In all cases, if we speak truthfully, we have no regrets and we have no apologies. But let me come to the question that was last. I know we need to close it. When we say that the informal sector doesn't pay tax, I think that is not a correct position, because you need to specify which tax you make the claim that the informal sector doesn't pay. And that's the problem with discourse in our country. It's not true. The informal sector, some portion of the informal sector may not pay taxes. And whenever people say that, they're referring to income tax. And pay as you earn requires you to start paying at a certain threshold, which I think is about slightly less than 20,000 shillings. Most informal sector firms, or most informal sector, are usually one person or two people doing a business on a roadside. Some of them are very, very small, so they don't even meet that threshold. So asking them or accusing them of not paying tax is not true, because the Income Tax Act, passed by Parliament itself, decides that if you charge, or rather, if you earn less than a certain amount of money per month, some amount less than 20,000 shillings, then you're not supposed to pay tax. So in the first place, they would not qualify. What other taxes may be available? The other taxes that are available are what we call generally the VAT, excise taxes, and all those. And if informal sector people or informal sector businesses or persons who work in the informal sector buy goods and services like you and I buy, they pay that tax. So it's important for us to situate this conversation by being fixed upon, as Leo told us, we need to be specific about what we are saying. So it is not true. And finally, as I conclude, I say that because of the fact that most informal sector firms actually earn little money, as Leo has mentioned, and that's perfectly demonstrable. Speaking about expanding the tax bracket, meaning at the same time saying that there's a lot of money out there that's going to be approved, is something the KRA, certain members of parliament, and certain accountants who are big voices and big thinkers say the evidence for us suggests that would be a wild goose chase. It would raise not just transaction costs, but it would raise enforcement costs for the KRA and not necessarily release as much revenue. And just like even in tax collection, you're required at the same time to obey certain principles. It would not be worth spending 100 million shillings, say, in KRA time and resources to get less than that amount. It is not useful. But those who are saying that the informal sector should pay taxes need to be careful, because then they are saying that the threshold ought to be brought down from under 20,000 shillings to 5,000. If you do that, for instance, yes, you'll get more people in the tax net for pay as you earn, but I'm not necessarily sure that that situation will be politically acceptable. So let's be careful with claims about that. It is a fallacy that informal sector does not pay tax. I am not excusing here other people who work in certain, even professions, who do not pay taxes generally because they qualify. That is tax evasion. But most of informal sector people in Kenya would not reach the threshold that is required to qualify to pay income taxes on a year-by-year basis. Thank you.
Okay, thanks for the response. I hope that suffices, Carlton. And given the time, I will not allow any further questions. Yes, so thank you all.